morning. I'm Nicole Albury, and I'm the Head of Distribution at Associate Global Partners. Today, we have the pleasure of speaking to Ryan Quinn, Client Portfolio Manager for WCM Investment Management. Before we begin, some short housekeeping messages and a message from our compliance team. This video is for educational purposes and of general nature only. It does not constitute personal advice. It must not be acted on or relied upon. And this presentation is not an offer, a recommendation, or a solicitation. Now, with that out of the way, Ryan, thank you so much for your time today.
Oh, my pleasure. Happy to be here.
Let's jump straight into it. I'd really love to cover a little bit as a bit of a reminder to everyone listening here today, a bit about WCM and their investment philosophy and how you think about picking stocks for the large cap portfolio.
Sure. So WCM, we are a $90 billion US dollar money manager based in Laguna Beach, California. We believe in concentrated, high conviction portfolios that take a long-term time horizon, investing in global growth stories. There's a number of things that we do that sort of everyone does. We screen the universe down into basically getting high quality growth businesses, ones that have high and rising return on invested capital, history of strong and growing margins, usually sticky customer relationships, high barriers to entry, all those good things. But where our process differs from our peers is, number one, how we focus on competitive advantages. We build portfolios on our top 35 to 40 ideas in the world that we can make the case are growing their competitive advantage. Or if you take the example of Warren Buffett's idea of an economic moat, having a moat isn't enough. We have to see a moat that's expanding, and we want to identify the drivers of that expansion. So that really drives our fundamental work in terms of selecting that high conviction portfolio. And then we support that with a qualitative effort that we've honed in on over the last decade or so that focuses on corporate culture. And we've developed a framework that is a kind of a three-legged stool that looks at companies to identify that the culture is aligned with the company's competitive advantage, that it is strong and widely held across the entire firm, and then it is adaptable over time because these businesses will face external threats from competitors and the market environment, but also internal threats as they grow and add headcount and add divisions and those types of things. So when we find businesses that are getting stronger, growing their competitive advantages, that are supported by well-aligned, strong and adaptable cultures, that's when we get very excited about a name we can own for a long time.
Excellent. Thank you. That really sets the scene for us today. And so if we now talk a little bit about markets, if we wind back to 2024, it's been a pretty good run for global equities looking back on that 12, 18-month period. However, coming into 2025, we've really started to see significant volatility, especially since the beginning of the year, and then again in the last week or so, even more still. What have been your main observations as it relates to the large cap global growth stocks?
Yeah, it seems as flipping the calendar page seems to make a lot of difference in markets. But last year was a good setup for growth investors. We saw growth companies outperform value businesses by over 12% last year, putting up, the market putting up a fairly decent kind of mid-teens return. We were able to significantly outperform that in this fund through stock selection. So being able to pick, some real winners in different sectors, whether it was industrials or technology, drove some significant outperformance last year. This quarter, it's important to remember that we do take a very long-term time horizon. If you try to react to every day's headline, you're going to get whipsawed. The last 3 days of trading alone have been, two days of a bloodbath, and then today was, this incredible market rise. So, investors are always sensitive to these things. They want to know, what are you doing in response to so and so being elected, or this legislation change, or tariffs, or whatever the headline of the moment is. And really, that's when we feel like we have an advantage because owning 35 to 40 stocks. We're not making large market bets. We're making individual company bets. And so we can really drill down into the underlying business and understand if the headline makes a difference to this company or maybe it doesn't. And even if it does, is it worse than the rest of the market? Because if we're going to be the cleanest shirt in the dirty laundry, many cases, that's a way to protect capital in these volatile periods. But we have certainly made some changes to the portfolio with some businesses, and as I mentioned at the top, we have to make the case that the competitive advantage is growing. And when businesses have these external impacts that are going to negatively impact the trajectory of their business, then we have 200 plus stocks on the sideline that are fighting to get in the portfolio for capital. So if there's something on the sideline that has a better moat trajectory or a better runway of opportunity, or said a different way in this environment, less headwinds, then we very easily switch out the business that is facing near to medium term headwinds for something that has longer term better opportunity.
Excellent. Thank you. And now we've talked about this a little bit. Obviously, you mentioned we don't want to take a short-term view, and all of our investors are long-term investors, so we completely agree with you there. Given what's happened since the start of the year, is there anything that WCM have been doing differently to manage the portfolio in these volatile markets, or is this actually a time where there's opportunity for WCM?
Yeah, I think we've sold sort of two stocks out of the portfolio given the negative impact that the tariffs would have on their businesses. Something like a Floor and Decor, which is a flooring business, or something like Canadian Pacific Railroad, which has been a long time holding the portfolio, but just that was enough of a headwind for that company to make it a source of funds for other ideas. I wouldn't say by and large we're making a lot of changes. However, we have been reacting to things like an improving environment in Europe, given kind of the events of recently. We're seeing Germany passing litigation that will allow for greater infrastructure spend, which has excited us. We can be contrarian in where we work. China has been, unloved by the market for quite some time now. They did see a bit of a stimulus package announced in the late innings of last year, but that was sort of short-lived. So we've spent quite a bit of time in country there to find some really great ideas, and it might surprise some people to find that we're very bullish on China, especially domestic-oriented businesses.
Excellent. That's really, really interesting. And so can you give us a bit of a short summary of how the portfolio has performed year to date relative to market, and some of the bigger contributors and detractors that we've seen?
Yeah, short-term performance these days is sort of, you have to kind of pull up Bloomberg or something to quickly look, because I think yesterday we started out quite strong and then ended up in the negative, and the day before that was just negative everywhere. Then today we started negative and rocketed to phenomenal heights to close the day. So it's a day by day thing at the moment. But what we've seen, if we zone out a little bit for kind of the certainly the first 3 months of the year, things that we have implemented and got excited about, literally coming out of 2022, have been leading performance for the portfolio in this recent period. Anyone who's heard me speak when I'm in country and talk about, obviously 2022 being a difficult year for growth investors, and I speak about it with a bit of a badge of pride because of how much work we did to really identify different areas of the market that we needed to get exposure to, that we thought would be able to really drive long-term returns. Specifically, aerospace and defense exposure was added to the portfolio throughout 2023, 24, and really those businesses are now being recognized by the market as very strong opportunities. So anything related to propulsion of airplanes, as well as the broader theaters of defense, have done quite well for us this year, and we're pleased that these investments that we identified quite some time ago are really carrying the day through what is a very volatile day by day, week by week environment here. Don't forget, we saw DeepSeek come out in this past quarter, which served as a short-term headwind to some of our semiconductor related and artificial intelligence related businesses. It's to be seen exactly what the long-term impacts are there. And then certainly all the tariff talk has also been quite noisy in terms of creating volatility. But having a balanced portfolio that isn't just tech all the time or healthcare all the time. We do own niche industrials businesses. We own digital payment businesses. We have exposure to e-commerce. So while we are concentrated in our highest conviction ideas, that doesn't mean we make very, very narrow bets. In fact, we fight for the opposite. We fight to have an extremely balanced portfolio that should be able to outperform in all different environments. And as we sit today, we're comfortably ahead of the benchmark.
Yeah, perfect. Excellent. That's really helpful. You mentioned China a little bit earlier. Um, we've talked about tariffs a lot over the individually and together over the last little while. How does the tariff war impact how you're thinking about the individual companies and sectors in the portfolio today?
Yeah, so tariffs, as I mentioned, are going to be really a company by company specific discussion. And if it impacts our level of bullishness about the idea, and it doesn't impact something that's maybe outside the portfolio, we'll consider changing there. By and large, we haven't had a lot of turnover because we did so much work coming out of 2022 to diversify the portfolio. As it relates to China, what we found, we spent quite a bit of time in country last year as well. And early in the year, it was clear that the Chinese consumer was quite weak, and it led to us reducing some of our luxury exposure because we felt like that lower and middle income Chinese consumer was not reliable to be durable through this period. So that did lead to a bit of a portfolio change. Interestingly, we noticed that the best management teams had found religion around capital allocation. So businesses that were just growing by throwing money against the wall and trying to just see what stuck, those ones we significantly avoid. Whereas when we find management teams that really understand the weight of the decision of where you're placing your capital, how you're going to be growing and how you're going to be taking market share from your peer set, that those are businesses we're getting very excited about. And China has a very unique market dynamic in that when geopolitical tensions are high, or when global governments are criticizing or being negative towards China, that consumer tends to look inward. And when they have the opportunity to buy China-made or China-owned businesses over an international company, they'll choose the China-based business. Think of Li-Ning Sportswear versus a Puma or Adidas or something of that nature. Luckin Coffee versus going to a Starbucks. And so we've been able to find some really great domestic businesses that really won't be impacted by tariffs or that matter, sanctions or delistings or any of those types of things. Tencent is an example, as is Meituan. Meituan has the majority market share in food delivery business in China. They also have a couponing business that has relationships with over 400,000 merchants. So these are very much insular, inward-looking Chinese businesses, and we are seeing the government making really strong strides towards more stimulus, getting the real estate market under control, and supporting their domestic consumer, which should lead these very high quality businesses to get only stronger, regardless of what is driving global clicks around the world for news.
Fantastic. So it's a bit of a crystal ball question, I think, this one. What's WCM's current outlook for global growth stocks? And then I guess less of a crystal ball question, which sectors and regions are you finding the most compelling opportunities today?
Yeah, we're always of the mind that if you're going to make predictions, you better make a lot because most of them will be wrong. So we're always doing that conviction analysis on our companies and try to understand how we believe, what our differentiated view is, and why we believe they're going to grow better than what the market expects. I think we can all agree that we're off to a volatile start this year. There's no visibility into calmer waters in the future. So that just means we're prepared. When we get these periods of volatility, our number one rule in the playbook is to upgrade the portfolio. The market gives you at times incredible discounts to purchase businesses at levels that are more emotional from the market's perspective than they are fundamental. So we're constantly looking at at our favorite industries and sectors to make sure that we are really playing offense and acting on our front foot when we get these buying opportunities. As I mentioned, so much of our work was done 12, 18 months ago to really diversify this portfolio into multiple business cycles. It's almost more now a relative value play in terms of which business has the best opportunity within this theme that we care about. And so we're paying close attention to, not only what we own, but also what we don't own, because I think the best prediction I can make is that, yeah, it's going to be a volatile year. And then of course, as every year, there's going to be something that no one's talking about that's going to have a huge impact on this market. It's just the unknown that's always out there.
Fantastic. That's a very good point. And the WCM investment team has a real history of capitalizing on opportunities in a market like the present. We've talked about this a little bit, but can you give us some examples of a couple of names that you've added to the portfolio recently and how they meet your moat, trajectory plus culture criteria?
Sure. So we added Saab to the portfolio last year as an exposure to European defense spending. There is estimates of somewhere around $800 billion of European defense spending that's expected in the coming year. Saab is a Swedish business. They make defense weapons and fighter jets and ground combat weapons, as well as surveillance systems that are going to be, helping NATO countries really upgrade and modernize their current military capability. Sweden is being admitted into NATO, which should make things easier for Saab to sell into NATO nations. And from a cultural perspective, they've restructured their business. They've embraced this change, that they are improving their supply chain. They're working much more closely with customers on specific product development, and they've also simplified their product count. So by doing positive things internally at a time when externally their business opportunity is getting stronger, that led us to really adding this as a very strong defense prime that will benefit from global defense spend, and specifically within Europe.
Excellent. Sounds like a really interesting stuff. Well, I think that's about all we have time for today, but thank you so much for your time, Ryan. If you have any questions about the fund that we haven't answered today, please contact any of the distribution team or contact us by calling 1300 052 054 or emailing us at invest@associateglobal.com. Thank you all for your time and have a great day.